I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, September 26. We've witnessed a brutal September so far in the financial markets, but certain indicators and historical trends offer reasons for hope. Of course, the U.S. Federal Reserve dominated the financial news last week, and the reverberations were felt around the globe. The Fed hiked its policy rate by another 75 basis points, 0.75%, and signaled a continuation of restrictive monetary policy. Foreign central bankers are emulating the Fed's tightening, raising the odds of a worldwide economic slowdown, if not an outright recession. The summer rally disappeared, with stocks revisiting bear market lows. Interest rates are now at their highest level in more than a decade, and as Fed Chief Jerome Powell indicated last week, they're about to get a lot higher. Market sell-offs, they're never fun. And I wouldn't blame you for feeling considerable anxiety about your portfolio right now. But conditions underlying last week's rout provide legitimate reasons for optimism. First, let's review last week's carnage. Take a look at the following table. For the week, the major indices posted the following declines. The Dow Jones Industrial Average minus 4%, the S&P 500 minus 4.6%, the tech-heavy NASDAQ minus 5.1%, and the MSCI EAFE minus 3.1%. EAFE is an acronym for Europe, Australasia, and the Far East, the most developed areas of the world outside of North America. Crude oil prices fell by 7.1%, and the 10-year Treasury yield rose to 3.68%. Now let's review the bullish signs. We appear to be heading for what the technicians call a double bottom. A double bottom pattern is a charting pattern that depicts a change in trend and a reversal of momentum from previous leading price action. It describes the drop of a stock or index, a rebound, another drop to the same or similar level as the original drop, and finally, here's the good news, another rebound. The double bottom appears like the letter W, and the twice-touched low is viewed as a support level, and the launch pad for a bullish upward trajectory. The Fed has been aggressively hawkish, but I think we're closer to the end of the tightening cycle than the beginning. Historically, when the Fed's policy rate peaks, market performance is robust in the 12 and 24-month periods that follow. Keep in mind, it's the earlier stage of the rate hike cycle that generates the most negative market reactions. It's always dangerous to project your own interpretations onto the often contradictory utterings of Fed Chair Powell, but by staking out an uber-hawk position to prove his toughness on inflation, Powell left the door open for pleasant surprises down the road. Inflation is showing signs of peaking. If these signs continue, the central bank will have elbow room to get less restrictive. Recessions are unpleasant, sure, of course, but the silver lining is that a substantial economic downturn would probably prompt the Fed to pivot. We won't get a dovish pivot in 2022, as originally hoped, but it could occur in 2023, which would boost equity markets. Also unpleasant are bear markets, but they're not uncommon, nor are retests of their lows. Take a look at this chart. Here are the past 6 bear markets for context. Historically, over the past 50 years, stock market performance has been strongly positive in the 12 months after a bear market retests its lows. These graph lines you're looking at now should give you encouragement. Bond yields have been surging, and although it's too soon to say they've reached a peak, it appears that the majority of the rise has taken place. After yields peak, stock and bond returns typically benefit. What's more, the average post-World War II bear market has lasted about 11 months. At the age of 9 months, this current bear market is getting long in the tooth. For these aforementioned factors to have traction, we need to see market capitulation, i.e. investors reaching complete despair and throwing in the towel. Are we there yet? Have we reached market capitulation? It's too soon to say, but economic data in the week ahead will provide important clues. Let's take a look at the week ahead. In coming days, keep an eye on the following: S&P Case-Shiller U.S. Home Price Index and Consumer Confidence Tuesday, pending home sales and another Powell speech Wednesday, initial jobless claims and U.S. gross domestic product revision Thursday, personal consumption expenditures PCE index, consumer spending, and inflation expectations Friday. The big data point will be PCE. If it comes in harder than expected, well, watch out. Want to mitigate the risks I've just described without sacrificing performance? Turn to Jim Fink, Chief Investment Strategist of Velocity Trader. In a new Investing Daily video, Jim Fink reveals how he hit 626 winners and 647 closed trades. What's even more amazing is that Jim's unshakable strategy worked as well during our last bull market as it did during the pandemic-induced crash, and as it's still doing today. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching.